Welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take your stock-related questions tonight, Chantal Marx, FNB Wealth and Investments, Willem from Nitrogen Fund Managers. Please be sure to send your questions. Email stockwatch@bdtv.co.za, SMS 41392, or on Twitter using hashtag Stockwatch. Lady, gent, appreciate your time. Chantal, let's start with you. I'm going to assume that you have read the Richemont Sense announcement this morning. It wasn't so very complicated. They're selling their Yux Net-a-Porter, getting a 33% equity stake in the buyer, and that'll then see a 1.3 billion euro write-down. Your take on it? They're online, as I understand, this is mostly their online, and has never really done as much as perhaps it could have.
Yes, so Net-a-Porter in itself was a pretty good business, and it is still a good, profitable business. But the tie-up with Yux complicated matters a little bit, because Yux is more an outlet type of store. It was a lot more difficult for them to really reach profitability within that business, and that's dragged down the entire online space with it. They've tried to add scale by introducing a variety of partnerships. I know that Farfetch was involved at some point, but they ran into financial difficulty. And really, I think that this is probably the best move for Richemont right now. Take the write down, take the stake in My Theresa that's growing quite fast with a very energized management team behind the company, and kind of separate it a little bit from the core business of Richemont, which is producing and selling high-end luxury jewelry and watches and a few other things in between.
And staying with you, Chantal, I mean, Richemont, surely with the job starter we saw Friday, with the Chinese stimulus coming, I mean, Richemont's invariably a good investment, but in this case, perhaps even a stronger case for it, as we've seen some weakness in the last couple of months.
We have, and the rating isn't demanding at all. I think it has been dragged down over the last 6 months or so by that negative sentiment surrounding China, that also coming through into their sales results. But obviously, when that kind of narrative starts shifting and you see continued strength in international travel, it should be quite positive for Richemont. Remember, Richemont is also quite defensive, as is the luxury sector generally, because their target market are the ultra-high net worth. It's the ultra-high net worth category, and they tend to be less exposed to kind of the ebbs and flows of economic cycles. But certainly, I think that the environment has improved a little bit for them, and that rating looks cheap.
Yeah, they're not, as you say, the ebbs and flows, which hits us mere mortals. Willem, let's bring you in. Your take on Richemont. As Chantal said, the deal looks decent enough, and the valuation not too stretched.
Yeah, I think I have to agree with Chantal. The two businesses, the sort of luxury, sort of high-end sort of bags, watches, luxury goods segment, and internet sales didn't really sort of match each other. I think in terms of the size of the transaction, it's not too large, and the write-off was sort of expected by the market. The sort of Net-a-Porter business never sort of got good commentary from management or the market in general. And then I have to agree in terms of sort of long-term quality investment, the exposure to China is good, and if the stimulus that's been announced over the last sort of 2 weeks were to be followed through on and sort of be implemented, it would definitely be a positive catalyst for Richemont's business there.
Next day with you, Willem, a question was coming through about Naspers Prosus. Two parts to the question. Why is there still a significant discount to the Tencent NAV, and does this present opportunity?
Yeah, I think that's a very good question. Sort of, you look at the price action over the last week or so since the start of the month. This often happens when Tencent has very strong sort of price action, especially on the positive side, when Naspers and Prosus lags. I think in the last sort of big rally, the constant buybacks that are being implemented by management did support the share. But your view is completely correct. The discount narrowed or widened by about 5 to 7% over the last 7 days. So, given that, I think you have to be, you have to say there is some optionality for upside in Naspers and Prosus. And the rest of the portfolio is also doing incredibly well. If you look at Meituan, their sale in T-Com, Naspers and Prosus stays a very, very good investment. In terms of growth and value, there's a lot still to be unlocked there.
Chantal, Naspers Prosus, which ultimately, of course, is predominantly Tencent, which, of course, is China, and brings us back to that stimulus of 2 weeks ago. Your take on the two counters?
Yes, I mean, I think from a Tencent perspective, there's still ample upside. The valuation is still very cheap relative to where it was prior to everyone starting to hate China. So I think that there is still upside. It's a lot cheaper than the likes of the US tech stocks. And I think that the growth profile is still pretty decent. And of course, you do have that scale, and that adds a little bit of defensiveness to that counter as well. That should flow through to Naspers and Prosus. And then I do see scope for that discount to narrow. We do have profitability coming through in the e-commerce business now, and some of the other investments are also doing very well. I've been so surprised with how the food delivery space has evolved over the last few years, because 5 years ago, I couldn't see a world where these companies were actually profitable, but they are turning profits. They are especially becoming more profitable as they gain scale. And the Naspers delivery kind of segment certainly has decent scale both in Europe and in South America. So I see continued scope for growth in those other underlying areas of the Naspers stable as well.
Yeah, I never thought that food delivery could make money, but it turns out they can. Chantal, let's stay with you. Question coming through. AB InBev held it for a year and a half. It's done absolutely nothing. Should I carry on holding? And in part, they're just so giant. They're sort of, I'm going to call them ex-growth, and maybe they would disagree. Maybe you would disagree. Chantal, AB InBev?
Yeah, I mean, it's a massive company, right? And it's a consumer staples company that is too big to make additional acquisitions, really, that's going to move the needle. So they are going to be very dependent on volume growth going forward that I think they could probably get in the next year or so with some macroeconomic tailwinds coming through, better consumer disposable income globally. But I think that the trick for them is going to be to fix their balance sheet and to fix it properly, because once you can get them to actually meaningfully pay down debt, I think it could have a really positive impact on their bottom line kind of run rate on that base that they've formed. Because post the SAB Miller acquisition, that business has been over leveraged, I think, and that's had a negative impact on its profitability metrics. So yeah, I do see scope in those areas. We've actually put out a technical call on the company today. We think it looks good from a technical perspective as well. So perhaps not the time to sell just yet. There is still hope. It's just not exciting.
It's not exciting. Willem, I mean, Chantal mentions SAB Miller. I mean, those were the real winners here. The folks who sold at what? I think £42 for their SAB Miller shares. Willem, your take on AB InBev?
Yeah, I think you guys nailed it on the head. It's a mature company with a lot of debt. So unless there's a growth lever to pull, which I somewhat agree with, but to another extent, I think there is sort of a global sort of health sort of ESG factor coming in terms of smoking and drinking. So you have to sort of take that into account in terms of where those sales are going to come from. I think what is positive is it's a highly geared company, and we're seeing interest rates globally sort of starting to taper or to decline, which means they'll get a big tailwind based on the sort of massive leverage they carry. But other than that, I'm also not excited. I have to say, it's not a high growth industry, and at the moment there's not that much to catalyze any growth for them.
Okay, and Willem, stay with you. A question coming through around education stocks on the JSE. This has to be a bit of a growth industry. Have you got a preferred Kiro, Advertech, Stadio, either, all of them, none of them, some of them?
So I'll do them in a list. So I think Advertech's by far the best. I think they show growth, very good management team. Over the last sort of 3-4 years, they completely weathered COVID and kept growing afterwards. They're buying massive properties in Sandton to build universities. Yeah. Their class rates are good. They're filling up their classes, which is a very high margin sort of activity. So once you've sort of got the class, you've got 10 kids in it, every single enrollment or students after that is pure margin. So I think they're very well set up to go forward. I think secondly would be Stadio. The tertiary sector definitely has sort of a space for sort of more growth, and there's lots of demand for that sort of education in South Africa. And then thirdly, Curro, the results there for me personally over the last sort of 5 to 10 years, they haven't really delivered to expectations. And since they've been unbundled from PSG sort of 2-3 years ago, haven't really done anything to draw our attention. So yeah, definitely Advertech, Stadio, and then Curro.
Chantal, your ranking of the education stocks?
My list is exactly the same. So I think just in terms of Advitech, I just think that they've done so much in terms of investing in that brand equity, and it's going to be really, really good for them longer term. This business is now 35 years old. I think if we get it to 50 and 60 years old, you're going to start having an alumni network that can really contribute to the coffers of some of these schools and the newer universities that are being put out there. So yeah, it's very, very exciting. It's an area where government has not been able to keep up in terms of population growth and kind of spatial expansion in South Africa, and these private education institutions have really moved in. The university side probably more attractive to me than the higher education side, or the high school and the primary school side, just because I think that gap is so much bigger there in terms of demand and supply. I think the stats are shocking in terms of how many kids pass matric with a bachelor's pass and don't get space in a public university. And these guys fill in that gap beautifully. And they also have a range of possibilities in terms of costs and mode of delivery in order to meet that demand.
Question coming through. Chantal, I'll stay with you because we touched on Balwin on the week that was on Friday. That was a horror update. We now, earlier today, had the Calgro M3 update, which is going to earn maybe as much as 100 cents for the 6 months, which, R2 a year on a R6 stock. The question I had earlier on my Twitters was, why can't Balwin be Calgro? And that's the complicated part. But I mean, is there a sense that if we can see what Calgro is doing, maybe Balwin, or is it a case of forget Balwin, focus Calgro, or maybe neither?
So I would actually say both. I think what differentiates Calgro from Balwin, particularly over the last kind of reporting cycle, is that they were exposed to an area of the market that is chronically undersupplied. Yeah. So the cost points that they have is much lower than the cost point of a Balwin apartment, for example. And it's much more a need rather than a want scenario. Now, we know when interest rates are high, inflation is high, and consumer confidence is low, you go for the needs and not the wants. But housing is a need. Better housing is a want. So I think in the interest rate cutting cycle, the want could start actually benefiting a little bit. And what I actually liked about the Balwin trading update was that growth in the annuity income stream. I think they can continue to push that, and it could be a completely different business in a few years' time.
Willem, we've got a minute before break. Are either of these, because these are micro caps, I mean, are either that you follow and have a sense of?
We have a good sense on Calgro. I think the report today was very good. I think they sort of took a bit of a knock with their CFO, CEO sort of both resigning in sort of short succession early in the year. But on a 3 forward PE, it definitely warrants sort of investigation and sort of finding out exactly what drives the earnings, because that's an incredibly low valuation for a property stock on the JSE.
Yeah, and it's probably, I'm not even sure what its book value is, although a lot of that would be land bank. Question coming through, is it time to short Capitec? I got to say, it's an expensive stock, it's a crazy stock. I know a lot of people who've been shorting it. I don't know anyone who's made money off shorting Capitec. Would you be shorting here, or perhaps even, what the flip side, which is actually a buyer?
Yeah, so I don't think shorting Capitec makes any sense. Like you say, we don't know of anybody who's shorted it and done well. Since the inception, that company's been beating growth results, and they pull levers left, right, and centre. I mean, they do insurance, they do credit, they do business. I don't see that management team stopping doing that. So in terms of shorting stocks, that's generally sort of a very difficult game, and it's sort of generally a losing game. Markets go up. So in terms of shorting a good growth company, sort of that's still with lots of room to grow, like in Africa, in business, in insurance, I don't think that would make any sense at all.
Chantal, we again chatted this on Friday, the week that was, and you made the point, it's almost become a kind of core holding in a portfolio. And the stock is not cheap, but it also did 36% growth in HEPS and dividend for this last set of numbers, which kind of justifies the not so cheap nature.
Yeah, so I think that when it comes to buying a company like this, when you need to think about your kind of holding horizon. So if you are looking to buy something that you're going to keep for the next 10 or 15 years, then it shouldn't really matter that much where your entry point is right now, especially if the stock is going to continue to compound growth at the rate that it's growing. And even if it's slowing, you do get you'll still do really, really well with a company like Capitec. If your holding period is shorter, then you could look for opportunities to enter the stock. So perhaps when they don't have a really great 6 months, when the cycle turns against them a little bit, or when there is some sort of rumor around them again, because this has happened in the past. So you will get that opportunity. But as a very long-term investor, that opportunity might not come. It might only come in 3 years' time, where the stock has done another 60 or 70%. So I see it as a core portfolio holding. I think it's one of those stocks that you have to have in your portfolio. You can perhaps think about phasing in some money into a company like Capitec, but generally, I don't think you should worry too much about entry levels, and you definitely shouldn't think about shorting it, because, as Willem mentioned as well, there are so many good reasons why you shouldn't short the stock that is just fundamentally growing in the way that it's growing, with an energized management team that's just looking for the next big thing.
But I like the point you alluded to there. Thank you, Viceroy, for opportunity on Capitec. I think it took it down to around 750. Chantal, we'll stay with you. Question around diversified miner. Is our best diversified miner on the JSE BHP bulletin?
Yeah, so I would think from a returns perspective, if you look at return on capital employed, BHP is a better capital allocator, and by that measure, I would say that it's probably our best diversified miner. But the others aren't bad either, and the investment case around some of them is actually pretty compelling. So I think if you're looking at something like Anglo American, we have had some issues in the past, and more recently, kind of a massive downturn in diamonds and platinum that has hurt them a lot. But there's a lot of value that is locked into that conglomerate, and I think that they can unlock a lot of that for investors still. And then Glencore, I think, is so interesting as well, because they are actually very aggressively pursuing growth in kind of new era metals, and that's something that a conservative team like the BHP management team probably won't do.
Yeah, well, beyond copper, which of course they tried and failed. For them, BHP or Anglo, or maybe it is Glencore?
Yeah, so I think BHP is by far the best run, best capitalized, and best cost-based diversified miner that we have exposure to on the JSE. In terms of what Chantal said, I have to agree that the 3 or 4 we have, you can even include something like an African Rainbow Minerals in there.
Yeah.
They don't all do the same thing. So we have the big diversified miners basket, but the commodities or the underlying drivers aren't that similar. Like, most of them are exposed to copper, some have coal. But I think it's more sort of deciding what you want to be exposed to in the medium to long term. And for me, I think BHP does make sense. It has a large allocation to very, very low cost iron ore. And then they are aggressively looking to expand into copper, which both metals make sense. Iron ore mainly sort of for India and maybe even Europe, and copper just for the green revolution. So I think there's been a bit of a rally over the sector in sort of the last sort of month or so. But based on current valuations, I still think BHP makes the most sense in terms of an entry point and sort of valuation for diversified mining on the JSE.
Willem, next day with you has come to Bidcorp. Question coming through, almost flat over the last year of holding Bidcorp. Is there still hope for this business? I got to say, I chat with the CFO every 6 months with results, and the results are invariably always better than I thought they would be. Maybe I set my bar too low. But Willem, your take on Bidcorp?
That's a fair point. Bidcorp is an incredibly well-run company that grows its earnings sort of year on year. I think recently they are a rand hedge, and I think the sort of exposure to the rand has been sort of hurting some investors over the last year or so. But in the medium to long term, I don't think that's a reason to sell the stock. If you want to measure your gains or your share price in dollars, or half of the share in a hard currency, and that would sort of take away the fact that the rand has sort of hurt your investment. But overall, Bidcorp has been very good. They're sort of decently rated, but again, with results that back that up.
Yeah, Chantal, I like that point. As Willem says, they're decently rated, but the results do stack it up. Your take on Bidcorp?
Yes, so I mean, Bidcorp is another one of those companies that I actually view as a core portfolio holding. I think that the stock is the company is incredibly well managed. I really like their strategy of making small bolt-on acquisitions in a very fragmented market, and in that way, kind of extracting value outside of just organic growth or relying on restaurants to keep on buying more food to sell more food. So I really like that strategy. I like the fact that it's diversified geographically. It's not just centered on South Africa, but also equally not just centered on Europe or the UK. So just a brilliant business. I think it's cheaply rated at the moment. And a company like that moving sideways for a year, I think offers an opportunity more than anything else.
I take your point, because earnings are up over the past year. There's no way, earnings are up, so actually you're getting a better valuation. Chantal, let's stay with you. Question coming through around Astral Foods. As the consumer starts picking up, the question is, could we see more chicken consumption? We've also got all sorts of fun and games at Quantum. We've got Rainbow that's come to market. Would Astral be on your shopping list at this point?
Astral is never on my shopping list because I don't like being anxious about what's in my portfolio. And it's an extremely cyclical stock. I think most of the poultry producers would be, because they're so dependent on input costs, and input costs, the biggest being feed costs. And that is a function of maize prices, and maize prices are a function of supply there, demand there, and weather. I don't like being dependent on the weather. So a lot of volatility in there. It is a really nice trading stock though. And I do think that they could see a bit of an improvement in their revenue run rate, and then also in their costs coming down a little bit. Perhaps not necessarily from their feed costs, although that will also certainly help them. But I think that some of the input costs that they've been facing over the last few years might dissipate a little bit, particularly on the electricity side, because they were very hard hit by load shedding.
Absolutely were. And of course, Chris Getter leaves at the end of January. He's been there as long as I've been in markets. Willem, Astral Foods, Chantal's right. It's a cyclical stock. It's hard to call it.
Yes, it's a risky business. Last year we had sort of a bird flu getting into the industry, and you just heard stories about there won't be any eggs on the market in December, and then it's water issues, then it's electricity issues. So in terms of sort of making a business case, it's not easy. So I'd also steer away from sort of the chicken industry in South Africa. Okay.
Question coming through around Motus, with consumer sentiment improving, rates coming down, inflation. We know the story, two-pot money. Willem, is the opportunity there in Motus? Of course, there's also We Buy Cars, although they're second-hand. There's Zeda, there's CMH. It's quite a little sort of sector we have got there. Motus, would that be on a shopping list?
Yeah, I think you might be a little bit late to the party on something like a Motus, or sort of the auto industry in South Africa in general. There was a lot of opportunity sort of early in the year to add to that sector, but the expectations that have been priced in haven't materialized at all in terms of earnings. So the whole market's seen the two-pot, we've seen the GNU, we've seen the potential of interest rates coming down, but the car sales and the rental sort of businesses in those businesses aren't doing well on a sort of on the ground level. So we're now sort of, if you're buying now, you need to hope that results will be even better than expected in 12 months' time. So I'd sort of take a chance to just sort of observe the market and see if there might be a better entry point in sort of the next 6 to 12 months, especially on results. Because if you look at the month-to-month vehicle sales and sort of auto manufacturer results out of Europe, it doesn't seem that things are going as well on the ground as the expectations are pricing in those stock prices.
Yeah, our September vehicle sales were up, but not a heck of a lot. We, of course, had a CMH update, which was for the period ending August, which was bleak. Chantal, Motus?
Yes, I was one of those early backers of the cycle turning, and I do think that we have seen some improvement in those share prices over the last few months or so. But a release like that one from CMH just highlights that we still have data that needs to come through that's going to be reflecting a period of macroeconomic pressure and consumer pressure, and it's not going to be an immediate step change in new vehicle sales, for example. So I think that it's going to take a few months to come through. Perhaps in the next 6 months things start looking better, but it still means that we probably have another 6 months of pretty bleak results updates, and that could provide a really nice opportunity. That said, these stocks don't look expensive. I actually like CMH, Motus, and We Buy Cars at the moment. But yeah, you might have missed the initial rally now, and you could get a better entry point later.
Yeah,
Feels like a cop-out.
We did see some weakness in CMH when that trading update came out. Let's go to stock picks. Chantal, you're going with Richemont. We chatted top of the show. The stock you'd like and is your pick this evening.
Yes, so I think that Richemont has been under quite a bit of pressure over the last few months because of the China story. We have seen some recovery because of the Chinese stimulus story, but I think that there's still some room to go. Not only in terms of what is on the cards for the Chinese consumer. But I think over the very long term, you will continue to see luxury goods demand increase as wealth grows, particularly across Southeast Asia and the Middle East. And then I think that this Yoox Net-a-Porter sale is actually going to relieve a lot of pressure for them, bring management attention back to the core business. And the core business being hard luxury makes me prefer this company across some of the other luxury retailers, just because it tends to be a little bit more defensive.
Perfect. Willem, you're going with US long-term treasuries, the ETF TLT listed in New York. What's your rationale there?
Yeah, so you've seen sort of equity markets do fairly well over the sort of three broad geographies. I think China is the most recent one, preceded by the US, and before that preceded by South Africa. The latest jobs figures on Friday looked incredibly strong. And this gives you a chance in long-term treasuries to lock in sort of 4.5%, 5% on dollars, while you're sort of waiting to see what all the risks in the world are panning out to be. So the key ones would be the Middle East and US elections. And I don't think there's any need to sort of be in equities over those two events. I think the Middle East tensions are very near term, and the US elections are obviously sort of a month away. And both of those have the potential to give you sort of good entry points. So I think it's a good time to lock in your dollars at 5%, and then if there were to be a pullback in equity markets, you would have the cash to deploy. So that's the main rationale for some long-term US treasuries.
Gotcha. Great. And it's a great little ETF. I've held it at points, but we'll leave that there. That's all for tonight's Stockwatch. Thanks to our guest, Chantal Marx, FNB Wealth and Investments, going with Richemont. Willem Oldewage from Nitrogen Fund Managers, going with TLT. It's a US long-term treasury ETF. Up next, the close. Stay tuned.